Hi, I'm Ross from Coomsmith 150 Group Property Accountants, and I'm just going to go through the new interest deduction changes and what they really look like in some real life examples. So I'm going to share my screen and go through, a property that I recently went through. So this is a brand new two-bedroom property in Christchurch that we went through just last month. Obviously, it's brand new. So one of the key things they're looking at putting in an exemption to the interest deduction. So rather than this being brand new, we're going to have to say it's slight or almost brand new so that it's not getting the exemption. So normal property, I'm going to go pretty quick through this, but we've done a video on this about a month ago, so you can always look at that and I'll put the link in the comments. But basically, bought the property for 500,000. I add in some costs, you get some sort of contribution back, $500,000 mortgage. I always work on 100% mortgage. And then we've got 51 weeks, $455, 23,000 income. That's a 4.63% gross yield. Then less all the different expenses. This one had some shared costs, so I put a body corporate in there or some extra costs. Higher insurance for Christchurch. It's basically brand new. We're saying almost brand new now, so there's some low repairs and maintenance. And then I've got some travel, maybe North Island down to South Island for this property. To me, yeah, I'm going to say a crappy property. I might as well say a crappy property. It's average. It's not great. It's losing $140, and that's at interest only and at 2.29%. We then claim chattel's depreciation, gives us a loss of $5,000, ring fenced because it's making a loss. You could offset against other rentals, but if it's your only rental, you can't offset against your personal income. Normal risk with this one is what happens if we go on to P&I. If we put it on principal and interest, we're losing about 12,000 a year. So it's a big cash loss. To me, it's not a great property. There's no added value. You can't subdivide it or anything like that. And the cash flow is not great. So then what happens if the no interest deduction rules come in? The rent is obviously the same. All the expenses are the same, but we're not getting any deduction on interest. So therefore, our net surplus sort of before depreciation for tax purposes is 11,000. Less depreciation of 5, we're 6,300. We're then going to pay tax. Say it's at 33%, just for example, 2,000 tax to pay. We're going to be down $2,217. If you put that into weekly, it's $43 a week you'll have to put in. So to me, not a great rental, and that's the problem from the start. So at the end, it's struggling. We then look at obviously the key thing with property, and this is to me why the 10-year bright line rules doesn't matter at all. If you're a property investor, you shouldn't be selling that quickly anyway. You want to hold property long term. You want to hold it for 10, 20, 30 years. You don't just want to hold it for 5 or 10. So to me, bright line, absolutely no difference. You should be holding your property anyway. And if you look at this graph, why I like it is it's impossible to really pick what is going to happen, but you'll see GFC 2007, 2008, the median was about 340,000. Obviously, if you still owned that property now, you'd be doing really well, probably worth over 600,000. So even buying at the real peak, still great gains long term. And that's the key. Residential rental properties is a long term game. You need to keep for 10 years anyway. So to me, bright line, no problem at all. I then work on some conservative numbers. I've got rent going up, inflation. I've got interest rates being miserable and conservative going up to over 4%. So what does that look like? So normally we're looking at the property going from 500,000 to 881 over 10 years. We're looking at the rent slowly going up. We're looking at all the expenses going up and interest going up to 4%. So you're looking at some cash surplus, basically a loss the whole way along. So to me, really average property, not that great. At the end of 10 years, we're hoping this property's gone up 380,000 and costs us 37,000 of cool hard cash. So about 3,700 a year. Again, very average property, but if this was your only rental, putting in 37,000 to hopefully get out 380 is actually not that bad. So what happens if we change it to no interest deduction? All the rent and figures and capital gain are the same, but obviously we're not allowed interest deductions. It slowly comes in. So to start with, the 21 year or the 22 year, we can claim most of the interest. 21 year, no change. 23, a little bit less until we're not actually getting any of the interest deduction in the 2026 year. So what that means is we're going to start paying some tax, and over the whole time we're going to pay 25,000 of tax. Going to the bottom figure, we're looking at still the same 380,000 of capital gain, but now it's going to cost you 6,200 a year. I've got a little example of comparing those two that I'll flick to in a minute. So to me, it's actually not that different. Yes, it's worse, but it's mainly because this is a crap property to start with. So it's not actually that great, and it just sort of shows that you need to get a little bit better cash flow. You need to do something that gives you, better return and works well. And just remember, this is now slightly older property. If it was a new build, the interest deduction wouldn't take effect. You'd still have the same old numbers. So it's only if this is not a new build that you won't get that the interest deduction will drop off over time. If we go through another example really quickly, so we've got a Hamilton brand new. Again, if we put it to slightly old, Hamilton 3-bedroom, 30,000 rent in, really low gross yield, 28,000 expenses, 2,000 profit, less some chattels, making a loss. If we go to ring fencing, we've got, $20,000 of income less expenses, excluding the interest. Then depreciation 14,000. You're going to pay about 4,600 in tax. So what happens overall is you're making 2,200, paying 4,600 in tax. You're down 2,400 or $46 a year. Over a whole 10-year period, we're looking at hopefully it going up 600,000 and costing 77, whereas it used to be 600,000 gain and costing 30. So if I show a quick summary of those, so over a whole 10-year period, we're looking at the Christchurch almost brand new property was going to cost you 36. Now it's costing 62. You're still looking at the same capital gain. Your total equity gain, if you have to basically use mortgages and that to pay this shortfall, you're looking, instead of making 380, you're making 318,000 capital gain over the 10 years. If you do the Hamilton slightly old 3-bedroom, you're looking at, in the past that it was going to be some cash profit. And so some cash surplus. Now it's going to be a cash loss after paying the tax. Over a whole 10 years, it was going to cost 30,000, with me being miserable and conservative and interest rates going up to 4%. Now it is 77. So you were looking at getting 593 capital gain. Now, because of that loss, it's more like 516. So has that substantially changed property investment? To me, no. It's just the same age old, that you need to buy a property that is right for you. What is right in your situation? If you could quickly pay down the debt, something like this might still be right. I think this one is a bit average. But this one still could be right for you if you've got really good income, you've got money that you can pay off, you've already paid down your personal house. So to me, this equation hasn't really changed. You still are gambling on capital gains, but I have been very miserable and negative as well. So and just remember, new builds, they don't come into the new interest deduction rules. They don't come into the bright line rules. If you're restructuring, buying a property and you're a client of ours, flick me through a quick email if you haven't. I've been up a lot last night answering those questions and trying to get back to as much as I can. And I've still got more that I'm working through today, but I will come back to those. So if you're an existing client, flick me through an email that you're restructuring or buying in the next few days, and we can just double check that's done right. Otherwise these rules are slowly going to come in, and to me, not a huge impact, but it'll be really interesting how the market works. So to me, still buy a good property where you can add value, get good cash flow, nothing really changes, and as long as you look at a long-term gain, Like I said, 10-year bright line, who cares? Look at a long picture, 15, 20 years, something like that. So hopefully you've enjoyed that. And yeah, and I'll put the link to the old one out up on the comments in a few seconds as well. Thank you. Bye.